Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Roku.
If you find our talks useful, please consider subscribing, liking, and commenting underneath.
And a quick note before we get into today's stock. If you need emergency cash and want to look at a short-term installment loan option, you can check out MaxLend Loans through my link below. Eligible customers may qualify for loan options up to $3,750, and funding may be available quickly if approved. But please be careful. Always read the full loan agreement, APR, fees, repayment schedule, and total cost before signing anything.
All right, let's get right into the hook for today's talk. I want you to just picture your TV screen right now. Like when you turn it on in the living room, what do you actually see?
It's usually just a chaotic mess of apps, right?
Exactly. It is this overwhelming battleground. You've got Netflix, Disney, Max, Hulu, Prime Video, all of them just practically screaming for your attention.
Yeah.
And they're spending billions, literally billions of dollars on premium content just to keep you from clicking away.
Yeah, the classic streaming wars. People have been talking about that for, the better part of a decade now?
Right. But here's the thing. While all those content giants are locked in this incredibly expensive, bloody battle for your eyeballs, there is one company that's just quietly making billions without firing a single shot.
It really is the ultimate gold rush scenario. I mean, while everyone else is out there in the mud, panning for gold, burning through cash, trying to produce the next big hit sci-fi show or prestige drama, this company isn't mining at all.
They're selling the shovels.
Exactly. They just set up shop at the base of the mountain, they sell the shovels, and they collect a toll on every single transaction that happens in town.
And the company running that toll booth is Roku. So our mission today is to analyze Roku's explosive Q1 2026 financial reacceleration. We want to look past the physical hardware, those little black sticks or boxes you might have plugged into the back of your TV years ago.
Right, because that's what most people think of when they hear the name.
Yeah, but we need to understand the real story here. All right, let's move into the wealth building context. We're looking at a company that has rapidly, almost invisibly, evolved into a massive global platform. Because the numbers they just posted, they don't just beat expectations, they completely shift the narrative of what this company actually does to build wealth.
Yeah, the market has struggled for a long time to figure out what Roku actually wants to be when it grows up. Like, are they a hardware manufacturer? Are they a software company? An ad network?
It's been a bit of an identity crisis.
It really has, but the financial data that just came out essentially answers that question definitively. We are looking at a mature software and advertising ecosystem that just proved, without a doubt, that it knows how to monetize its user base at a massive scale.
So true. Now let's look at the fundamentals. Because to understand why the market is buzzing right now, we have to look at the raw numbers that just dropped for Q1 2026. Total net revenue hit $1.25 billion.
Which is a huge beat.
Huge. That's a 22.4% year-over-year increase, decisively beating Wall Street consensus estimates. But when you really lift the hood on these earnings, the entire story is in their platform segment.
Yeah, the platform revenue is where this modern business model finally reveals itself. That segment alone surged 28% year over year to $1.13 billion. And what is really critical to understand about that $1 billion is how perfectly balanced it is.
Right. It's not lopsided at all.
Not at all. Advertising revenue came in at $612.7 million, which is up 27%. And meanwhile, subscription revenue climbed 30% to $518.5 million. So this isn't a company relying on a single trick. It's a highly diversified stream of income generated entirely by software.
I want to break down those two buckets real quick, because I think a lot of people just assume Roku is still just selling a piece of plastic at Best Buy.
Yeah.
Let's look at the subscription side first. If I sign up for, say, Paramount Plus or Peacock through the Roku interface on my TV, Roku is taking a percentage of that monthly fee, essentially forever, just for facilitating the sign-up, right?
That is the exact mechanism, yeah. They are basically the digital landlord. If you rent a storefront in their mall, meaning your app is on their home screen, they take a cut of the commerce that happens there.
Which brings up the classic razor and blade business model. They sell the razor handle, the physical streaming stick, for incredibly cheap. Sometimes they even take a loss on manufacturing it.
The hardware is just a loss leader.
Exactly. It's a Trojan horse. Because once it's plugged into your TV, you are locked into this highly profitable walled garden ecosystem where they take a cut of the replacement blades for years.
And what's fascinating here is how that razor and blade dynamic dramatically alters the profitability metrics. It's all about operating leverage.
Right. Explain that a bit for the listeners.
So when a business relies on selling physical hardware, every new customer costs a lot of money. You have to manufacture another stick, box it, ship it, put it on a retail shelf. The profit margins are terrible. But when you transition to selling digital ads and software subscriptions, your margins become incredible.
Because delivering a digital ad to one more television costs them practically zero additional dollars. The software infrastructure is already built.
You're capturing the exact mechanic. They don't just make more money as they grow, they make money exponentially more efficiently. And we saw the result of that efficiency in this quarter. Their adjusted EBITDA, which strips out one-time costs and gives us a look at core operating profitability, it surged 165% year over year to $148 million.
Wow. And Wall Street was expecting, what, like 131 million?
Yeah, they completely blew past it. That represents an 11.9% profit margin.
See, it's the swing in net income that really caught my eye. They went from a $27.4 million loss in the same quarter last year to a positive GAAP net income of $85.7 million this year.
It's a massive turnaround.
Yeah, going from burning tens of millions of dollars to printing nearly $100 million in pure bottom line profit in a single quarter.
Yeah.
I mean, that is the textbook definition of a fundamental reacceleration.
And they're generating record trailing 12-month free cash flow to back up those earnings, too. It explains why management was confident enough to raise their full year 2026 guidance.
What are they projecting now?
They're projecting $5.535 billion in total revenue and $675 million in adjusted EBITDA. They are heavily signaling to the market that Q1 wasn't a fluke. This is the new baseline for the company's earning power.
That brings us to the catalyst timeline, because that level of free cash flow has to absolutely terrify their competitors. And we aren't talking about small startups here. They are fighting Amazon with the Fire TV, Apple TV, and massive television manufacturers like Samsung. So if we know they're printing cash, the logical next question is, how are they maintaining this growth against literal trillion-dollar tech giants?
It comes down to a very specific strategic moat, and the sheer scale of that moat is intimidating. They just crossed a massive milestone, 100 million streaming households globally.
And that isn't individual users, right? That's 100 million living rooms.
Exactly. It makes them the largest single gatekeeper for television monetization in the world. But their real advantage isn't just their size, it's their neutrality. They call it their Switzerland-like positioning.
Okay, let me push back on that a bit, because I hear industry analysts talk about this neutral Switzerland concept all the time. But put yourself in the shoes of the average consumer sitting on the couch with a remote in their hand. Do they actually care who makes the menu screen?
Not really, no.
Right, to me, an app grid is just an app grid. So is this neutrality thing just insider hype that doesn't actually translate to real consumer behavior?
Well, you're actually right about the consumer. The viewer on the couch generally does not care at all. But the neutrality matters immensely to the content providers and the advertisers. And they are the ones actually paying Roku.
Oh, I see.
Yeah, think about the dynamics between the major streaming services. If you're running Disney or Netflix, you are extremely wary of Amazon's Fire TV or the Apple TV interface.
Because Amazon and Apple have their own multi-billion-dollar streaming services? If I'm Netflix, I know Amazon has a vested financial interest in pushing their own Prime Video shows to the top of the home screen, basically burying my content.
Precisely. Roku doesn't have a massive original content studio trying to crush Netflix or Max. Because they don't directly compete with the content providers, they're viewed as a safe harbor. They become the preferred, unbiased aggregation layer for the entire industry.
Okay, I see how that protects them from the content side. But earlier you mentioned advertising revenue was over $600 million this quarter. How does being neutral help them sell ads? Are they just calling up brands and selling banner space manually?
They do some direct sales, yeah, but the real magic is in the automated advertising plumbing. Roku has deeply expanded its integrations with major demand-side platforms, or DSPs.
Like who?
We're talking about Google DV360, Amazon's ad network, and the Trade Desk.
Let's pause there for a second. For anyone who doesn't live and breathe ad tech jargon, what is a demand-side platform actually doing in the real world?
Sure. Think of a DSP as a high-speed, automated digital auction house for advertisers. A brand, let's say a car company, tells the DSP, hey, I want to show my new commercial to 30-somethings who watch sports.
Okay.
In the milliseconds it takes your TV screen to load a menu or launch an ad-supported show, these algorithms are bidding against each other for the right to show you that specific car commercial.
So because Roku is a neutral platform, they don't lock these ad agencies out. They open their doors and let Google, Amazon, and the Trade Desk all plug their auction houses directly into the Roku home screen.
Yes, and that creates a massive network effect. Because their ad inventory is universally accessible to all the biggest platforms, Roku essentially becomes the ultimate, inescapable toll booth for connected TV.
Because if a brand wants to run a comprehensive ad campaign, they practically have to use Roku.
Exactly. They have to drive through Roku's toll booth to get the sheer volume of households they need.
That toll booth analogy clarifies a lot. You have all these different streaming apps acting as isolated theme parks, and Roku is the only major highway that connects to all of them. But I was looking at the tech specs, and there is a hidden hardware advantage that just blew my mind.
Oh, the memory footprint.
Yes, we always separate software from the physical TV, but it turns out Roku's proprietary operating system uses 50% less memory than its rivals.
Yeah, that is a highly underappreciated structural cost advantage. See, when you walk into a big box store and buy a third-party smart TV, not a Roku-branded TV, but maybe a TCL or a Hisense, you have to understand that the manufacturer of that physical television operates on razor-thin profit margins.
Right, they're trying to keep prices as low as possible.
Exactly. Every single microchip, every gigabyte of RAM inside that plastic casing eats directly into their bottom line.
Wait, so if I'm building millions of budget TVs to sell for $300, every component matters. Are you saying that because Roku's software code is so lightweight, TV manufacturers can actually use cheaper, lower capacity memory chips in their hardware and still get a fast menu?
That is exactly the mechanism. As global memory costs rise, Roku's efficient code literally saves television manufacturers money on the assembly line.
That's wild.
It is. It creates a massive financial incentive for these third-party brands to pre-install Roku rather than trying to build their own software or, use a heavier competitor's OS. That structural advantage accelerates third-party TV adoption, which just continuously feeds new living rooms into Roku's 100 million user base.
It's a brilliant backdoor strategy. This software efficiency basically subsidizes the physical hardware market. And speaking of catalysts, look at their recent product execution. They recently added Apple TV and Peacock as premium subscriptions directly integrated into the Roku interface.
Yeah, smoothing out the friction for users to subscribe. But the much more aggressive move was launching their own low-cost subscription video-on-demand service called Howdy.
Right, and Howdy has already surpassed 1 million subscribers. That really highlights an incredible power dynamic. If you own the home screen, you don't necessarily need a massive marketing budget. You just place a tile for a new $3 a month service in front of 100 million captive living rooms, and boom, you instantly generate 1 million paying subscribers.
It's the ultimate distribution leverage. And speaking of that home screen, they're currently rolling out a completely redesigned user interface too.
What actually changes in the redesign? Is it just cosmetic?
No, it's highly functional. Early tests of this new home screen feature larger, more interactive video banner ads and streamlined navigation.
Does that actually move the needle financially?
Oh, absolutely. This has resulted in significantly improved user engagement and much higher click-through rates on their marquee ad units. When you are operating a network of this size, even a fraction of a % increase in ad click-through rates translates to tens of millions of dollars in highly profitable, high-margin revenue.
Now let's pivot to the chart and the technicals. Because the market reaction to all these levers being pulled has been explosive. The stock jumped 10% in after hours, trading immediately following the earnings release, and it's up 71% over the past year.
The momentum is undeniable.
And we are seeing a huge wave of institutional upgrades. You had at least 5 major Wall Street firms simultaneously raise their price targets to the $140 to $170 range. Wells Fargo bumped to $167, Citizens to $170.
Yeah, it looks like deep conviction buying from large funds, basically wiping out the previous bearish trends.
And the technical price action reflects that, right?
It does. When that many institutions aggressively revise their models upward at the exact same time, it typically indicates severe short covering. So people betting against the stock are forced to buy it back quickly, which just adds to the upward momentum.
So what does market sentiment look like internally? Because here's where it gets really interesting. While all these Wall Street institutions are piling in and driving the price up, the company itself is quietly and aggressively buying back its own stock.
Yeah, they repurchased $100 million worth of shares in Q1 alone.
Right. And that's just part of a broader $400 million buyback authorization They've already deployed $250 million of it over the last few quarters. What does that signal to the market?
A corporate stock buyback of that magnitude is the ultimate put your money where your mouth is signal. Management is looking at their own internal projections, they're looking at their massive free cash flow generation, and they're deciding that retiring their own shares is the highest return investment available to them.
It just communicates an immense level of internal confidence to outside investors.
Exactly.
But relentless optimism is dangerous, especially when we're talking about a stock that has run up 71%. So now let's talk about the risks. We have to stress test this thesis to give you a complete objective picture. What breaks this 100 million household machine?
The primary bear case usually starts with the legacy hardware business. We talked about how the physical streaming sticks are just the cheap razor handle designed to get you into the ecosystem. Well, the problem is that handle is getting more expensive to produce while selling less.
How bad is the drop?
Hardware revenue actually fell 16% year over year to $117.6 million. With global memory and supply chain costs rising, there is a real threat that device profit margins could compress into deeper negative territory later in the year.
So the physical entry point is bleeding cash. And on top of that, you have broad macroeconomic fears. We are looking at significant geopolitical instability right now, specifically the context surrounding the Iran conflict.
Right, the macro headwinds.
Yeah, traditionally, when macro fears spike and the global economy looks shaky, the very first thing corporations cut is their advertising spend. If Roku makes the lion's share of its money acting as an ad toll booth, a global pullback in ad budgets seems like a massive vulnerability.
It is a logical vulnerability, and bears point to it frequently. And if you want to add fuel to that skeptical fire, you also have to look at the insider trading activity.
Oh, right, the insider sales.
Yeah, over the recent period, there has actually been net selling across 210 distinct insider transactions.
I mean, I'm looking at two completely contradictory signals here. On one hand, the corporation itself is using hundreds of millions of dollars of its free cash flow to buy back its own stock, signaling massive confidence. On the other hand, the individual executives, the insiders running the company, are quietly selling off their personal shares across 210 transactions. How should we interpret that disconnect?
It requires context. It's incredibly common for tech executives to sell shares for personal financial planning, tax obligations, or portfolio diversification, especially after a stock has appreciated 71% in a single year.
That makes sense.
Right. Those individual sales don't necessarily reflect a lack of faith in the business. The corporate buyback, however, is a systemic, board-approved capital allocation decision based on long-term cash flow models.
So you would weigh the systemic corporate action heavier than an executive diversifying their personal portfolio. What about the other threats, though? The hardware decline and the geopolitical ad fears.
There are significant structural mitigants for both. First, regarding the hardware margin pressure, device revenue now represents less than 10% of Roku's total revenue.
Oh, wow, so it's a tiny slice.
Exactly. Even if the hardware margins compress further, the sheer scale of the 28% growth in the highly profitable software platform completely absorbs and dwarfs that hardware drag. And the company has already embedded that conservative hardware assumption into their raised guidance.
Okay, so the bleeding from the hardware side is essentially contained by the software profits. But what about the ad spend pullback?
Roku actually noted in their earnings call that they saw absolutely no impact on advertising spend from geopolitical challenges in Q1. And the reason for this insulation is structural. Connected TV isn't just growing alongside the broader ad market, it is aggressively stealing existing ad dollars away from traditional broadcast television.
Ah, I see. Even if the total global advertising pie shrinks slightly due to an economic downturn, Roku's specific slice of that pie is growing so rapidly that it offsets the macro headwinds. The migration of ad dollars from old TV to new TV is happening regardless of what the broader economy is doing.
Exactly. And looking ahead to the second half of the year, there's a massive specific catalyst for domestic ad spend, and that's the political cycle.
Right, the elections.
With major elections looming, analysts estimate there is over $100 million in political ad spend poised to hit the market. Connected TV is highly attractive to political campaigns because, unlike a broad broadcast antenna, Roku can target ads down to specific zip codes and demographic profile.
That is huge.
It is. That influx of hyper-targeted spending isn't even fully baked into their current conservative guidance.
So with everything on the table, what's the final verdict? When you synthesize the entire picture, The fundamental shift from hardware to high-margin platform revenue,
Yeah.
the 165% surge in core profitability, the rollout of a more engaging home screen, and the insulation from macro ad shocks the business earns a very strong 8 out of 10 bullish score for the next 12 to 18 months.
Yeah, management expects Q2 revenue to hit roughly $1.3 billion, decisively proving that their platform scale translates directly to massive profit leverage. They have survived the streaming wars not by fighting in them, but by owning the battlefield itself.
And the core wealth-building takeaway for you here is that true value in modern technology often lies in the invisible infrastructure. That physical streaming stick sitting in your living room gathering dust behind your television set isn't the real asset.
Not at all.
The real asset is the invisible advertising network, the lightweight software operating system, and the behavioral data of 100 million households that Roku quietly captured while everyone else was distracted fighting over who gets to make the next hit show.
And that reality leaves us with one final, highly speculative thought to ponder. Roku now boasts record free cash flow, 100 million captive living rooms, and dominant structural control over the connected TV market. In an industry dominated by massive tech and media conglomerates fighting a brutal multi-billion-dollar war for living room dominance, how long until one of those giants looks at the math and realizes that buying Roku outright is simply cheaper and easier than trying to defeat them?
Now, that is something to think about next time you pick up your remote. Need emergency cash? MaxLend Loans offer short-term installment loan options up to $3,750 for eligible customers. Apply through the link below and carefully review the APR, fees, repayment terms, and total cost before accepting any offer.
And if this episode helped you, please subscribe, like, and comment underneath. We'll see you in the next Smart Wealth with Joshua episode.